What is the best private mortgage you can get for your real estate investment or house flipping in Ontario? We're going to talk about that right now. What's going on, everybody? My name is Andrew, and today Ping and I are joined by a very special guest, Jesse Bobrovsky from Calvert Home Mortgage, and he's going to share with us a lot of very valuable information that you want to know for your next real estate investment property.
Thanks, Andrew. Thanks, Ping, for having me. It's been great to be on the show.
So let's start about the market, because the market has gone through all these fluctuations. We've seen a lot of changes. What is your outlook on it? I mean, it's obviously gone down a bit, some climb happening again. As a lender, what's your view on it?
Currently lending into two markets, Alberta and Ontario. We strictly focus on residential, and most of it is, call it 4 doors and under. Let's talk maybe first about Ontario. A year, call it 18 months ago, you saw this massive run up in prices for about a 6-month period. And then in late February, early March, when the Bank of Canada increasing interest rates in an effort to fight inflation, a lot of that heat got taken out of the Ontario market, and we saw prices decrease significantly and quickly. Basically, from March through October, in most markets, you saw 20% price decreases. Since then, particularly the last 4 months, we've seen stabilization, and in some instances, you've seen prices increase. But what's really interesting to me from the standpoint of residential economics is the lack of supply. Even through that downturn, yeah, supply went up a bit, but it didn't go up. Like very few markets, you saw more than 3 months supply, which was technically still a seller's market. You had sellers almost saying to the market, yeah, we agree, prices are inflated. We're just gonna sell our houses, decreasing prices. I found that really interesting. Typically, you see inventory really spike when you have those decreases, but we didn't see that in Ontario. And now we're back to a market where, again, you're seeing some price appreciation, but there's hardly any inventory. You're not seeing sales volume. So that is something that we're following closely. We're following closely indebted Canadians are. There was a recent report of the G7 countries were the most indebted. The bulk of that has to do with mortgage debt. A lot of Canadians during the pandemic took on variable rate mortgages, so their prices, their cost of servicing that debt has escalated significantly. And then we're following, and another big story is that goes with supply is the fact that we're seeing massive amounts of migration. Our residential real estate market is already undersupplied, so that puts more pressure on prices again to increase. So there's a lot of dynamics happening in the market. And as a lender, what we do is we follow micro and macro trends. So we follow GDP, we follow bond rates, we follow employment, we follow migration, and then we get into the more micro and look at like what's happening in the individual market, days on market, inventory levels, sales prices, to try to gauge how we want to lend our capital. So it's really interesting what's happening in Ontario.
There are obviously a lot of theories as to why the market is working the way that it is, and different types of, let's just say, different types of home buyers that are influencing why the market is operating the way it is. Even sometimes when you see people taking staggering losses on the properties that they bought, it's either that that money has to be being compensated from somewhere. Either they can afford to lose the money, which maybe some people are coming in and buying properties cash, and maybe these are the people who are losing, or the people are servicing the debt through other properties by maybe shifting the mortgages over so that they can float these losses and avoid the increasingly high monthly payments, just so they can get stability. So that leads me to the question of your target audience, the borrowing audience, because you lend primarily, I guess, for under 4 units, right, to investors, house flippers, and people. It's typically not single-family home buyers looking to live in a property, typically.
Typically, you're right. Although, while in Ontario, we're known as the lender who supports real estate investors with short-term capital, us as a company as a whole, we love to support any borrowers, any Canadians who are in need of a short-term mortgage solution. About 30% right now in our book is that homeowner. Last minute, they've gotten declined by the bank. Maybe income isn't quite there. Maybe credit isn't quite there. We love to take on those opportunities where there's a high likelihood of exiting either through refinance or through sale. And I want to make sure that our audience is understanding that we love anything short term. It just so happens that where we've really been able to support is to the real estate investors, but any short-term mortgages, residential, 4 units and under, that's where we want to help Canadians with solutions.
Are you able to define what short-term means?
I was going to question the audience.
And I leave it loose because I want to invite the deal. Like when you give firm definitions for a company like ours that is based on finding solutions. Sometimes if I give a firm definition, get my underwriters to work the magic they do, which is find solution. But the easiest way that we define short term is where there's a file with an extremely high likelihood of paying us out within a year or so. So again, like sometimes we'll get these files and the borrower will think, or the mortgage broker will think there's a high likelihood, but we look at it and we're like, oh, because of how bad credit is, or because of their reporting income, it's like, this isn't going to happen. Like, you're going to be stuck with us for a very long time, which we don't want to see. We're not the best lender for that. And in those instances, we give them ideas on who the best lender may be. But a lot of times the individual themselves may think that they're not going to get out within a year. But when we look at it, when we introduce them to an expert mortgage broker, or we just help the mortgage broker think through it, there is a solution there. So the easiest way for me to define it is a mortgage in which our underwriters believe there's a high likelihood of exiting within a year. So I want the market not to tell themselves stories. Like, if you think, yeah, there's something here, we want to see those opportunities to provide you a solution.
Okay, so in that case, when you say that there's a high likelihood of exiting, that means that you're offering a degree of flexibility. For example, right now with the market shift, there's a lot of people who, even in our case, when we're flipping certain houses or we have certain investments where there's an exit strategy, we may require to hold the property a little longer. And that's where the flexibility comes in, where it's approximately a year under certain circumstances.
Again, based off of our mentality of providing solutions, things happen. And sometimes the plan doesn't get executed as we intend. And we're not going to say, no, Andrew and Ping, give us our money back. We're not giving you a renewal. We're not going to do that. As long as you're performing, paying us, and communicating, we're going to renew it. We're going to figure out a solution that best serves you. But of course, we're managers of risk. So we have to make sure we're adhering to how we need to manage risk and what's right for us and our company and our shareholders. Again, we're in the business of solutions. We're in the business of working with our clients. We're in the business of seeing them be successful. And being rigid is usually not going to accomplish those goals.
Yeah. Jesse, how would you qualify a buyer, a house flipper investors? How would you qualify them versus the projects? Because again, like, it's all about mitigating the risk, and there's a long-term value that you guys always want to keep it under. You guys send out the appraiser to obviously appraise or assess the potential of the property and all that stuff. But I just want to get an idea for our audience. Like, let's say if anybody goes to your company, approach your company and said, hey, listen, like, I do want to start flipping houses. What are the things or the major things that you're looking at from these borrowers?
Yeah. And again, I'm going to talk in generalities rather than specifics. We're going to want to see firstly that the project is profitable. So we're going to look at the purchase price. We're going to look at the renovation plan. We're going to back out all the costs. We're going to determine whether or not this is the right decision for the borrower, and in turn us. We underwrite for success, profitability. You've accomplished the hardest thing in real estate investing. You've found a good property that there's a lot of likelihood of success. Now, we look at borrower, how are you going to execute this? Can you execute this? We look at, okay, do you have sufficient capital? Do you have sufficient experience? If you don't have sufficient experience, who are you going to be using for trade? Where there's individuals, we're blessed to work with individuals who have been doing it for decades and have flipped hundreds of houses. And those individuals, we don't have to invest as much time and energy into education. It's more just managing the specific file and just making sure that we're treating them right. Whereas with a newer flipper, we're going to invest a lot of care into them. We're going to make sure that they understand the risks. We're going to make sure that they're working with the right contractors, the right realtors, so that we're going to increase the likelihood of success. Because the newer you are, the more variables there are going to be to navigate through, the less experience you have. Again, a big part of our values is to ensure the success of others, and we'll spend the time with them. So in general, how do we look at a file? Is it going to be successful? We look at it through the standpoint of ensuring the property and project is going to be successful, and then ensuring the individual is going to be successful. And global lens, we've been really fortunate in seeing a lot of success through our borrower.
You know what? I think that leads into some of the reasons why someone would approach Calvert over any other financial institutions. For example, A lenders, B lenders, or even credit unions. If they're looking at a lender like yourself, you obviously offer a lot more flexibility. It's almost like the hoops that are required to go through they're simpler to go through, and they're more reasonable to appease. For example, if you're looking at projects, right, you're looking at more like through a business lens, which is very different than, let's say, how an A lender would look at things. Whereas if you are looking at things strictly from the Do you have a job in nursing, for example, that's obviously proven to be stable? Or do you have all these things that maybe don't matter as much to the project itself? So you're really investing in business decisions and you look at it through that lens. Is there anything that stands out for you, which is the reason why somebody would prefer to go through, as you approach an organization like yours versus a credit union, let's say?
We've talked about our expertise. Like, the borrower is going to get to work with underwriters who understand this. We're providing our expertise to the borrower, and in a lot of instances, increasing the likelihood of success. We've talked a bit about the solutions. We're a lot more flexible than the banks, lenders, credit unions, true banks, even the challenger banks, in that we love lending on houses that have significant deferred maintenance a hoarder had lived in. We see profit. The banks see risk. So a lot of times, just in and of itself, because of the houses that our borrowers are buying, it's a no. And we love that stuff. So we have the solutions. Part of our solutions is we also lend with extreme speed. So we built a business, process, systems, and people that literally we can turn a mortgage around tomorrow. Like, we can get an inquiry today, and by turn it around, I mean fund it. We have in-house appraisers at no cost to the borrower. So I don't need 5 days for an appraisal. We have in-house legal administration. So we literally send the instructions to the lawyer, and as long as your lawyer can move as fast as you want them to, the deal can fund. And our experts in our underwriters, we've enabled them to make decisions quickly. So that's another huge benefit. And then finally, we've built a product that really reduces the capital barrier to entry, and it also allows real estate investors to scale. So we can lend in Ontario with as little as 20 grand down. We can lend in Alberta with as little as 10 grand down. So again, newer investors love that because it allows them to get into a $500,000 house with 20 grand down. Whereas if you wanted to borrow from the banks, you're looking at least 20% down, 100,000. So they like that. Yes, our money is more expensive. We're pricing that risk in, but the most important thing is maybe, let's say on a 5-month basis, which our typical flip is, you're paying us 5 more grand than you would pay the bank. Well, guess what? You might not even be able to do the deal and make the 50 grand with the bank, where we're providing you that opportunity. Also, even our experienced lenders who have big net worth, amazing credit, could be bankable. The banks don't like the short-term stuff. When you're paying out every 5 months, the banks are not profitable at that. So they're using us because the banks straight up don't like the short-term mortgage lending. And then the volume. So again, hardest part of doing this is finding the right properties. We, through the low down payment, enable our borrowers to do volume. And now volume is a bit tricky because we never want to see our borrowers get into trouble. And especially the new ones, sometimes their eyes or their stomach is bigger than their eyes. Is that what, their eyes are bigger than their stomach.
Yeah.
Take on too much and they spread themselves too thin. So we watch them on that front, but certainly with the low down payment, it allows our clients to do volume.
One of the biggest tickers that people have to contend with, newer investors who want to get into house flipping, don't have necessarily a lot of capital, but they're good at doing what you said, which is finding the deal, right? And if they find a good deal, they have the potential to make the right amount of money. I think sometimes when you're talking about $20,000 down, I noticed you didn't say a percentage, but I think this is based on a certain range. Does it come with certain caveats? Like typically, if you do 5% down on a $500,000 property, $25,000 down, you're looking at you have to get CMHC. So are there any caveats that come with doing something like that with Calvert?
The $20,000 down program in Ontario, the caveat is it's up to 800. So once you go over 800, we're going to want 5 and sometimes 10%, depending on how big the purchase price is. But you can buy a house for 800 grand and we'll lend you 780 plus fees. The caveat is just like I talked about it back to our underwriting. It has to be profitable and you have to be able to execute. So if you're doing those two things, we're going to lend you with as little as 20 grand down. Now, on a loan to value basis, in the bulk of instances, our profitability test makes it so we're at a loan to value where we're comfortable. Like very rarely a real estate investor is buying a property, putting money into it, and the after repaired value is going to be greater than 80%. So for example, right now, our book in Ontario, the average after repaired loan to value is 60%, right? Because there's profit in it. The borrowers, every shingle they put on the house, every screw they put in, every faucet they put in is increasing the value. When we look at what the after repaired value is, sometimes you get it to where we say, oh no, you need to put more down. And those sometimes is where we refer to it as a wholesale, where basically they're just buying it, doing nothing and selling it because they're getting it at such a good price. Like they've negotiated such a good price with the seller. But that's rare. When there's enough profit, it adheres to our loan to value standard where we won't exceed 80. And in most instances, it's much below 8.
By the way, JC, for a lot of house flippers, they're also wondering if they can actually get a loan on the renovation or construction. Is that something you guys do?
Yeah, we don't. When you come to Calvert Home Mortgage, we will lend you with low down payment, but you have to have the capital to do the renovations and execute the project and service your loan. Now, that capital doesn't have to be cash in the bank. A lot of it, line of credit, sometimes joint venture. If you have a Home Depot card for 30 grand and your rental costs are 30 grand, that works. In a lot of instances where we're dealing with experienced investors that have a portfolio of properties, we'll use the equity in those properties. So, for example, you have a rental, it's worth $1 million. You owe the bank 600 grand. We would gladly lend up to 75% on that. So that's another 150 grand that we can direct towards your project. In that instance, again, this is why I don't like to talk in clear rules. In that instance, we're going to lend you 100% of purchase price, plus all the costs to renovate, because you're giving us security through another asset.
Mm-hmm. Is there cross collateral that you guys can leverage and essentially provide a solution for a house flipper to actually handle renovation without putting more money in?
No, that's fair. These all sound like very great practical solutions-oriented approaches towards the real problems that people are facing when it comes to getting into the real estate market. One, you're solving the capital purchase, because a lot of Canadians always look at house flipping in Canada versus house flipping in, let's say, the States, where there's a lot of programs to facilitate value-add propositions to a property, where they will lend you on the construction, they will lend you on the mortgage, and it's not so complicated to do. Whereas sometimes when people go do flipping houses through a bank, they're looking at 20% down, and then you have to spend about the same amount of money on renovations. You're looking at $300,000 on a property. That's a lot of money to have to put in. And if you wanted to do 5%, you have to do CMHC. Now, when you're doing the $20,000 down, you don't have to buy any extra insurance on that, do you?
No.
Okay, so instead of losing the money by having 4% roughly on the CMHC, that's now money that is a lot of, I'm sure a portion of that will go to Calvert, but it's now also going into a relationship rather than just going into insurance. CMHC, the money's gone.
Exactly. And that insurance policy, like, you're going to have to break it unless you're burring it, which works. But again, a lot of clients who burr, they're still borrowing from us and then going. So, and for our capital, right? Like, you're paying always a 2% fee. We split that with the broker, or if you come to us direct, it's 2%. So that's half of the CMHC fee. And then, yes, you're paying us a higher interest rate. Like today, our rates start at 9.9 and go up depending on the risk. But when you factor it in and you really, and if you were to analyze it apples to apples, typically we're less expensive than a 5% down insured mortgage.
Yeah, especially if you have a short-term exit strategy.
The bulk of our borrowers are getting rid of us in 5 months.
People who are learning about house flipping, they ask us, how do we pad down on these lender fees? Because it's the repeat lender fees that end up killing them over a period of time. And is this something where if they're doing, let's say, one every 4 or 5 months, they're doing like 2 to 3 every year house flips, right? So is there any kind of rollover or credits that you do for repeat usage?
Not typically. Like again, the 2% fee, which is the means to the end of making really great money, most borrowers see it as value.
Yeah.
But certainly we want to look at ideas to bring every entrepreneur wants to find out ways to bring down their costs. Like we some of our capital we borrow from the bank. I'm always looking to say, bank, we want to pay you less on our, for instance, standby fee or on a renewal fee. So we're always looking to generate as much profit as we can. So in some instances where, again, we talked about the borrower who has a house that has significant equity in it, we can just leave our facility on that house and then maybe charge an annual fee. We'll have to make sure as a company covering our costs. So we can make it a lot more flexible where we treat it kind of like a line of credit. You can pull money in and out and pay us down. And then we set up our origination fee and then we kind of just renew that ongoing. And then of course, when we have clients that are borrowing literally, everybody has their AAA client. We're going to find out ways to get them some beneficial pricing.
Yeah. So to facilitate things. And when people are exiting, are there typically breakage fees that come along with?
Never.
All right.
Like we always set our mortgages up fully open, interest only payment. If you pay me out in a day, we charge 1 day interest. If you pay us out in 450 days, you're owing us 450 days of interest.
No, that makes sense. And in that case, I don't feel like it's fair to ask for discounts even on the initial lender fee, because a lot of the concerns that people have with private mortgages especially is that it's easy sometimes to get in, but they kick you on the way out, and that's where you get your profits chewed. But if you're doing that, then you are working with them. There's no reason for them not to want to come back and set the thing up again.
And we're very fair with that. Like even on the fee side, where you see our industry being the alternative lending industry, in a lot of instances, they're feeing everywhere. We're not, right? Like it's one fee, the origination fee. We're not charging a legal fee. There's a discharge fee that the lawyers charge, and that's just it's charged, but we're not generating any revenue from that.
Yeah.
Even our NSS, like luckily we don't have any NSS, but right now our NSS fee is $25, and that's basically what we pay the bank.
That's beautiful.
We're the way Calvert makes money is through the interest rate we charge the borrower and through the origination fee, and we're not looking to juice up revenue.
This is why Calvert really has the good reputation in especially for a lot of investors in Ontario, because we see a lot of lenders trying to do that. There's a breakage fee, and then on top of that, there's a renewal fee, or as you continue scaling up, every mortgage, every lending opportunity, they're always trying to charge additional. For some cases, it will be the 2.5 to 3% lender's fee. So yeah, we really appreciate that. And then obviously with all the flexibility that you guys are offering, it has actually been an amazing experience with you guys.
I just want to, I don't want to lose this one point, because again, we like to be transparent. We typically never charge renewal fee, but we've been doing it lately. It's an option for a renewal fee. So for borrowers who borrowed from us, let's say this time last year, and we come up for renewal, and through the last 12 months from June, I think interest rates are up about 3.75%. So our cost of capital is up 3.75%. This is an anomaly. It's a very edge event, but we need to recapture some of that. So what we're doing now is we're saying, okay, borrower, you have the option. And what we've done is we've increased our pricing at half the amount the Bank of Canada has. So I'm going to use easy math right now. Let's say it's 4%. So we'll give the borrower an option to renew with a 2% increase in their rate, or to take a fee of 1%. And again, abnormal, but we've been talking about, we don't charge more. We're trying. So we've had to, because of this unique market, but this is the first time in our history that we've had to do this. And it's because of how quickly interest rates have risen.
And the truth is, it's very understandable, because again, every business needs to figure out how to be profitable in any different kind of market, right? So, house flipper or investors approach Calvert, would you guys prefer that the investors come with a business plan, talk about the ARV, the exit strategy, how the number comes up, or would you feel like that's more like a due diligence on the lender?
No, I want them. The best borrowers are the borrowers who own the process, the borrowers who are the entrepreneurs, the borrowers who understand, here's the comparables, here's my budget, here's how much money I'm going to make. Yes, we're going to put it through our due diligence, and we're going to make sure that their assumptions are correct. If you're just coming with, I'm buying this house, I'm not sure what I'm going to do with it, then how are you instilling confidence in me to lend you the money? So absolutely, as an investor, and just like any endeavor in life, if you're going to be successful, you need to own your own success. Owning your own success as a flipper is, again, knowing your budget, knowing what renovations to do, knowing how much you're going to sell it for because you've looked at all the comparables, knowing how long it's going to take you, knowing who you're going to use for a plumber, landscaper. The more you know, the higher likelihood you're going to be successful. So the bulk of our borrowers have done that. In some instances, we'll do the hand holding and walk them through it. But a lot of times when the clients don't come to us with a plan, it's usually not going to be successful because they've been provided an opportunity from some third party where the third party doesn't have a vested interest, and they say, yeah, it's going to be successful, buy this house. Where when we look at the numbers, it's like, no, it's not going to be successful. You should probably stay away from this. Or here's the research you need to do to ensure your success. Please come back to us on the next one.
It would be very good if you can almost have a standard where the point is that if Calvert says no to it, you're just like, okay, maybe my calculations are wrong.
We're not infallible. Like we've been proven wrong, but it's rare. I'll tell you, like you think we're lending on literally hundreds, thousands of flips, hundreds, billions of dollars. We have the data. We've seen it. And we're in the business of seeing you successful and seeing us successful, doing this long term. So we put a lot of effort and thought into your success. And if we're saying no, in most instances, it's not going to work out. And we've seen borrowers who've gone elsewhere to fund the deal. And in most instances, it's not successful. Again, but we're proven wrong. We're not infallible, especially during like where the market was increasing. We never allow our borrowers speculate. So even in an increasing market, yes, I'm looking at HPI data and building that into our valuation, but I'm not going to say it's going to be worth 10% more in 6 months from now based off of pure appreciation. I don't think that's a fair assessment to make. We're also not going to say it's going to be worth 10% less because we're not in the game of speculating. We're in the game of here's the value now. We're in a down market. In all likelihood, it's going to be worth less. We should consider that. Or we're in an up market. In all likelihood, it's going to be worth more. We should consider that. To promote pure speculation, we're not in the game of that.
When we're talking about the differences of why people might go to a private lender or an organization like Calvert versus A lender or B lenders, I think sometimes has to do with the drywall factor. So, for example, we see projects where somebody speculated on a project, started it, renovations cost way more than they were expecting it to. They demolished the place and then found out that they just don't have what it takes to finish it. And now there's no drywall. And banks won't lend on places so the place has no drywall, right? I have two questions for you. One, are you comfortable lending on places like that are just to the bone, which I'm assuming, there's flexibility there, but you can tell me. And then two, why is it that a lot of lenders won't lend if the place has no drywall?
So we love that. We love
no drywall.
the no drywall, because the way we see it is when there's no drywall, our borrowers, the renovator, knows all the issues. You can see everything. So we love that because now there's less risk. There's less variables. And we talked about, again, like the hoarder houses, the houses that need work, the banks don't like. And the banks don't like it for a number of reasons. First, it needs work. There's risk when a property needs work. There's risk that it doesn't get done. There's risk that it gets done poorly. There's risk that it takes longer. There's risk that they don't know what they're doing. So there's risk there, and the banks don't like that risk. That's kind of the main reason why.
If there's drywall, I always found it a little peculiar when it came to specifically the drywall. Even if it was a hoarder house and the place had drywall on it, they would be more okay with it. I've been able to finance through a bank as long as there was drywall. But the minute that you don't have drywall in the majority of the house, the appraisers come in and then the whole thing gets rejected through the process. So I always found that to be a peculiar thing because I guess what you're saying still applies because banks aren't geared towards house flippers.
And I guess, from the perspective of the bank, when even a hoarder house where there's drywall there, I'll bet you're not telling them I'm doing this massive renovation on my own. You're just saying I'm buying the house. Yeah. And they're okay with that because, again, look, you're not tearing it apart. They don't see the risk. Like it's worth 400 grand, buying it for 400 grand, whatever. It's worth 400 grand. But if you tell them it's worth 400 grand, I'm going to put 70 grand into it and sell it for 600 grand. They're going to say, oh, there's risk. We need to understand this. We don't want this. We like to stay within our lending box. Now, there are some companies that will do like a purchase plus improvement and stuff like that, but it's a different way to underwrite. It's different checks and balances. So banks are really good at building a very tight structure of risk and hiring people that can check those boxes and not deviating from them. The drywall factor deviates from those boxes. They say no. And again, you think to me, it's like, why are you saying no, bank? Well, the banks are doing 99% of mortgage. Like, we're insignificant. So the fact that they don't have to hire experts to do the work that we want to do is they're fine with that. They're just a big machine that spits out profit.
They're keeping it simple for sure. And I found this interesting, even their mortgage clauses. So one of the things I feel that addresses that question is that should you do anything to the property in a period of time that they are financing you, that devalues the property, they have the right to take over and do some stuff, right? So I'm assuming technically, if you take out all the drywall and take everything down to the studs, in that period of time, you've devalued the property technically. So I feel like that's kind of why they're addressing that. Not that it ever happens that a bank will come in. I've never seen it anyway.
How are they going to know?
Yeah, exactly, right. And that's usually one of the issues, which brings me to one of the next questions that largely has to do with some of the market. And I know this one can be touchy, but have you had to foreclose on anyone during this market?
It's not touchy at all. Again, we're in the business of risk. We are not properly managing risk if we're seeing zero defaults, if we're seeing zero problems. So of course, when the market goes down the way it does, that's going to increase our risk. We've managed through a number of those downturns in Alberta. Like in Alberta, you see downturns every 6 to 8 years, and they're significant and they last a while. So we're lucky in that we've built a business around managing risk and build checks and balances around that. And even our model of short-term lending creates more liquidity. We're turning our money over. There's a plan to exit even during a downturn. It's likely they're going to stick with that plan. So going back to what we've seen through this downturn. So we've been lending in Ontario for 3 years. I think we've lent about $400 million up until January, December. Up until December, we had no power of sale. Power of sale is the equivalent to a foreclosure. We've had NSFs and we've had clients that have problems, but we were able to work through it with them to solve their problems. And that's something I should note. We're always going to work with the client as long as they have a plan and they can execute that plan. There's no benefit to us to force them into a power of sale. It's always best for them to sell the house on their own. It's less expensive. You don't have a stigma of power of sale. Power of sale, you're going to reduce the value of the property by 5 to 10% just through the stigma. We always try to work with our clients through it. I think we've had now 5 power of sales. The tough ones are the ones that you said, Andrew, where they leave it at drywall because the market shrinks when you have a house at drywall. Luckily, we work with so many flippers, and the hardest part of finding a flip is finding the property, that we can help our borrowers solve their problems and say, hey, why don't you list it with this realtor who knows all the flippers? Or if you want, we can run it by 20 people in our network to see if they would like, you're in Guelph, we know 20 flippers in Guelph. Why don't you let us receptive to this? And maybe you can get out from under it. So we've had problem files. We've lost money on problem files. It's rare, luckily, and we work our butts off to manage through them. Historically, we see about 2% of our files in legal. So that would be in Alberta, foreclosure, or Ontario, it would be power of sale. And might not get this number perfect. Our average loss ratio is 0.34%. Banks are about 0.17, and industry average, like our alternative lending industry average, at least from the companies that report on this, is closer to 1.2. And that's well within our range. Like, we're doing a great job if we keep within that. And even during this downturn, I think last year we ended up at like 0.4. So quite good. And we took a very active approach during the downturn. Like, the way that we looked at it is the biggest at-risk properties within our portfolio are mortgages that we lent on November of 21, May of 22, right? Because you had this run up, then this steep drop down. And we literally reached out to every borrower. How are you doing? How's the project? Are you listing? And tried to suss out where the problems were. And then if there were problems, we'd right away value them at today's value, if reasonable within accounting standards. We'd back out interest, we'd back out a reserve for loss, and really get good reporting within our financials to our shareholders, so that what lenders could do is they could kick the can down the road. They could put their head in the sand and ignore the problem until they have to actually liquidate. And then it's like a surprise to shareholders, where we try to avoid that through good proactive file management.
How's Calvert operate in that sense? Do you have shareholders that bring capital in for lending as well, or how does that work?
We're a mortgage investment corporation. The legal entity that we are a fund. All of our money that we lend out is through Calvert Home Mortgage Investment Corporation. All of the revenue we earn goes into that entity, fees and rate. All the expenses we have gets paid out of that entity. And as a mortgage investment corporation, we are obligated to provide all of our annual net income back to our shareholders. Our shareholders buy units in our fund. Myself and my partners and most of our employees are all shareholders. We buy units in the fund, and then we manage the mortgages. We lend it out. We get paid out. We make money. Every now and then we have a bad mortgage and lose money, and it gets pushed out to our shareholders. Our year end is February 28th. Our auditors come in end of March through April. Our board meets at the end of April to review, approve, and then we push out our financials. We released our financials at the end of April, and our money flows out to our shareholders on or before May 10th of every year. This year, even in the downturn, we were able to push out a return to our shareholders of 10.76%. We deem that as really good. Like, for the way that we educate our shareholders is how we manage risk and the way we lend our money out and the price we lend it out. We're doing a good job if we're preserving capital. Like, our number one goal is to preserve capital, and in doing so, make sure that in these downturns, we don't get hit too hard. So when we're doing that, the return that we're trying to offer our investors is between 8 to 10%. We've been able to hit over 10% in most years historically. So our 10-year average and 5-year average is just over 10%. So yes, we have individuals, predominantly high net worth individuals who invest in us. We only accept accredited investors. An accredited investor either makes over 200 grand or has $1 million net financial assets. Our investor base, 18% of the number of investors have, I think it's 81% of our capital. So it's family offices. These families who are now professional investors and growing and generating their wealth for generations to come make up a decent amount of our shareholders. And then ultra high net worth clients with over $5 million liquid assets make up a lot of our shareholders. But we do have a lot of lawyers, a lot of mortgage brokers, a lot of realtors who invest in us because they understand real estate, they understand what we do, and they appreciate the business, and we treat that as a compliment. While we're not looking for those clients, right? Like, typically those clients are 100 to 150 grand investors. It's not our target, but we treat it as a huge compliment, and we'll absolutely accept those funds. But where the world is going and where we want to go, or where I'm hoping to go with this, is more and more sophisticated investors are looking for an alternative asset class, and we are an alternative asset class. So the fund managers that would manage for your teachers, for your you're well off, but not your extremely well off clients where they're managing maybe 500 grand, a million. If I go to those portfolio managers and say, hey, would Calvert be something you'd want to participate in? And they say, yeah, and they might have 2 to 3% of their portfolio in Calvert, then those, I'll call it retail investors, are still getting exposure to us. So what I'm working on right now as a leader of the fundraising department within Calvert is to try to reach out to those fund managers who understand our business and whose clients are looking for exposure to us yet can't get it directly because of how they're situated, and work with them. So that's something new that we're exploring, and I think it's going to. I think we're going to have a lot of success in doing that.
I love it. Basically opening up the opportunities to average families to participate. Is there any minimum investment amount that you guys are looking for?
Well, no, because we put the bar at accredited. Our minimum amount in our relationship disclosure document is $5,000. I don't think I've ever seen $5,000. But again, usually if they're accredited and it makes sense for them to invest in us, maybe they'll start with $50,000 in their TFSAs. They'll continue to do well in life and will continue to be an attractive investment, and we'll see that grow. Like, we have some investors who have grown an RSP account over 20 years well into the millions of dollars at putting 20 grand a year into it. Our minimum is being accredited, and then from there we'll accept money. Like I talked about, these brokers, realtors, lawyers, sometimes they'll start with 50, which we're more than happy to accept.
But 8 to 10% is actually very attractive, right? With an organization like you guys, because you guys do all the due diligence. It's extremely passive.
It's a professionally managed investment fund. So it's different than investing individually in one mortgage, in that you probably don't have the same expertise and resources as us if you're doing it individually. You're also not diversified, right? If that one mortgage goes bad, you're fully exposed and there could be problems. Whereas with us, you're invested in 800 mortgages across 2 provinces that act very different on Canadian residential real estate. And then also, because I used to invest in one-on-one mortgages myself. I come from a background of syndicated mortgage lending. The first 8 years of my career in alternative lending were syndicated, and I had the bulk of my financial worth in it. But what I found was I might earn 11% on a mortgage. When I look at how much capital is sitting stagnant, at any given time, 20% of my money is sitting there, not being used. So when I annualize that in and look at it from a portfolio perspective, my returns are being dragged down significantly. Never mind time I have to invest in finding the deal, in doing the due diligence to make sure it's a good deal. And then also knowing full well that if I'm getting the deal as an individual investor, it's because banks passed on it, and also mortgage investment corporations have passed on it, right? Like, usually a broker or a borrower is going to go to a professional lender. So I'm getting kind of the table scraps. So I'm getting the riskiest deals, and it's tricky to do.
It's very interesting to see how that type of thing would evolve, because if you think about it, there are a lot of people who are willing to lend into real estate, right? And even part of the model that we sometimes use is there's a lot of landlords that have a sum of money, right? Because they have like a HELOC, or they have they have the line of credit on the property. They have enough money to maybe invest in something, and they believe in real estate, but they don't have enough money to do it all on their own. So they're looking for something to join into, like a body that's greater, that they can invest into something that they believe in. But I think the reason why a lot of people don't do it is because lending on property is not as easily accessible as, let's say, stocks, where there's an app for it, right? So for Calvert to want to open the doors to be able to lend on something that real estate investors believe in on a smaller scale can be really powerful. And then we can see it every day that this is a gap in the market that people are looking for. How do you invest in real estate when you don't have enough to invest in a whole property, if there is an option through smaller fund managers?
There are publicly traded MICs too. There's Timber Creek. There's a few publicly traded MICs that are options too. Small guy who may not have access to even a portfolio manager that would have access to us. So I think that would be the easiest way. Problem with the publicly traded MICs is I don't think any are over 2 billion. Because of their size, the valuations move quickly. Like right now, if you look at some of these pubcos, I think, this is not financial advice, I think they're traded at a discount right now. So when you're a small publicly traded company and you're not widely traded and you don't have a big market cap, it's tricky because valuations swing heavily. There is liquidity, right? Which is great. Like with us, you're not liquid, right? We're liquid only annually for redemption. So that's one of the bigger risks investing in a MIC is the liquidity. But even the pubcos, like how liquid are they really? You're holding mortgages. So if everybody tries to liquidate, there's not that liquidity. It's similar to REITs, where you're holding real estate. Like when things are great, then when they're not, you got to concern yourself with that. So I agree. There is a gap. There are some solutions through publicly traded companies. There are opportunities because of that gap.
Even just based on what you're saying, 8 to 10%, that's a very decent return for someone that can invest completely passive. If you want to go over that to 15%, yeah, you are essentially assuming the risk of the projects that being profitable. You need to be fully trusting on the active partners or GP, right? And then sometimes that 4 to 5% of the increase on an annual basis may not necessarily be worth it to actually take on those risks. Yeah, it's purely logic. I love your analysis on that part. Do you prefer people to reach out to Calvert directly or still through the mortgage broker?
Either way, I think it's really important for them to think through the strategy. Like if they're burring properties, go through your broker because your broker already knows what your exit's going to be. They need to know your position holistically, especially if the broker is really educated in real estate investing. Use that education. Whereas like some of our super high volume people where they're just flipping, they don't need the broker. It's easier to communicate direct. Now that's rare. There's a lot of brokers, particularly in Ontario, who really understand real estate investing. So as long as you're with that broker, but there's also a lot of brokers who don't, and there may not be as much value in the transaction when that happens. But we love the broker network. 70% of our business comes through it. So I highly recommend going through a broker.
Because that was all really great information, I know that there's a lot of people in the organization, potential investors want to reach out to for Calvert. But if anybody wanted to follow you or send you a message, what's the best way to get in touch with them? Social media, email?
Through the organization, we have an awesome website. The website is geared towards borrowers. So if you're a real estate investor or if you're in need of short-term mortgage capital, go to our website, chmic.ca. That's also the best way to get a hold of our underwriters who are looking to serve our borrowers. We love phone calls, believe it or not. We have a mandate that we have to have an expert available to talk to our clients. So whether they're borrowers, investors, our lawyers, call us. We have an 800 number, 888-725-4642. And then myself, email. So again, in most instances, people would want to reach out, become shareholders. That's mostly what I do. So it's Jesse, Jesse @chmic.ca. But you can also find me on the website. The website is a great tool. And then we have a cool Instagram that we're consistently putting out educational content. And just it's at Calvert Home Mortgage. Please reach out. We love to engage with our audience, whether it's just thinking of doing a flip or thinking of investing or you want more info or whatever. Please don't hesitate.
Perfect. All right, Jesse, it was really great to have you on the show.
Thanks, guys. Thanks all for listening.